Hello, welcome to the video. My name is Blumino Morin, and in today's class, we're going to be going over 10 guidelines in investing in the stock market. If today is your first time of joining the class, I'd like to specially welcome you. And if you're a returnee, welcome back. It's good to see you again. In today's class, we're going to be going over the step-by-step procedure and criteria of what I look at when selecting stocks to buy for the long term. So without any further delay, let's get right into it. Number one, is this company changing or going to fundamentally change the way I live and I do business? Is investing in this company going to change our world? Is this a company or a product that I cannot do without? Is this a product that I use very frequently? For example, Google. When you need anything, you just Google it. If you need to shop online, most likely you go on Amazon, right? For example, if you need to connect with your friends and families, loved ones over social media, where do you go? Facebook. If it's not Facebook, it's Instagram. If it's not Instagram, it is WhatsApp, right? These products, they are interwoven into our everyday lives, and that really matters when selecting stocks that you want to buy and hold for the long term. Number two, does this company have a strong moat? So a moat is a formidable defense that fends off competition, right? The term economic moat, this was actually coined and popularized by the legendary Warren Buffett. So an economic moat is a distinctive competitive advantages that a company has over its competition that protects its market share and also its profit. So this usually makes it that no other company can replicate or mimic what the company is doing. So think of it as a castle that is surrounded with water, right? And in this castle, it has very good things, treasures worth billions and billions that a lot of people want, right? But for you to be able to get to that treasure, you have to be able to fend off all the crocodiles and the sharks in the water. It's the same thing when a company has a strong economic moat. Let's say, for example, Amazon. Amazon has built such a strong defense. No other company can easily replicate what Amazon is doing, right? For example, the 2-day shipping, the Prime, like it's so hard for other companies to be able to beat that. And because of that, we can say that Amazon has established a strong economic moat. Think, for example, Google. What other search engine do people go to? Google is such a market leader in that phase. Google is such a market leader when it comes to search engine, right? There is no competition. It has built this strong moat around itself that no other company can easily replicate what Google has done. Number three, the credibility of the leaders. This is very, very key because the tone at the top really dictates what happened throughout the business. Look at, is the credibility of these people, is it solid? Look at the CEO, the CFO, all the people that are leading the organization. Look at the people that are running the organization. Do they have a good track record? Have they run any company before? For example, when we look at Amazon, Jeff Bezos, solid reputation, right? Elon Musk, he has run different companies before successfully. When you look at Jack Dorsey, obviously Twitter and Square is the founder and he's been running these two organizations successfully. When you look at companies that you want to invest in the long term, you have to look at the people that are leading the organization and know that these people, I can trust them with my money. It's very, very essential. Number four, does this company have raving fans and customers? Never bet against a company that has raving fans and customers. That is very, very key, because customers are the bloodline of a business. Sam Walton, the founder of Walmart, he said it best. He said the reason why you are in business is because of your customers. Do people love the product, right? Do people love the product that you're selling? Companies that have raving fans and people love their product, over time they tend to do successfully because people are buying their product, and because people are buying their product, they are generating sustainable revenue over time, and that translates into good profitability over a long period of time. Number 5, do you understand the business? This is very, very key. How do you understand the business? By looking at the annual report, the quarterly report, listening to all of the earnings call, the annual shareholders meeting. Again, you have to stay abreast with what is going on with the company. And how can you do that? You can look at Yahoo Finance. You can even set up Google alerts so that every day you get notification. It could be once in a day you get notification on how the company is doing, and stay abreast with what is going on. It's very key to understand the operations of the business. For example, for me, there are some stocks that I really like, but I don't understand the business. And because I don't understand it, I don't put my money there, because what if something fundamentally changes about the company and I don't know how to interpret that? That means that I'm left holding the empty bag. So again, it's just like if you were to invest in a local business, right? You're going to go to the business, you're going to talk to the owners, you're going to talk to the co-workers, you're going to talk to the people that work there to understand how is this business doing, how do they operate. And if you don't understand the technicalities of the business, it's better you stay away from it, because you don't buy a company that you don't understand. It's one of the rules. Even Warren Buffett said it. You have to invest in companies that you understand. It's very, very key. Is this company still going to be here in the next 10 to 20 years? This is very, very important. There are 4 types of companies: the growing, the established, the dying, and the born to fail. And I heard this from Chicken Gina Singapore. That is a YouTube that I listen to very religiously. So let me explain. Growing companies. For example, the Tesla, the Shopify, Spotify, Netflix. These are companies that are disruptors and they are growing in their specific markets too. Established companies. These are companies that they've been in operation for several decades. Some of them have been in operation for 50, 70, 100, 120 years. For example, Coca-Cola, Disney, Johnson & Johnson. When you think of major financial institutions like the banks, right? They have been in operation for such a long time and they are very established and stable. And usually these type of companies, they tend to pay dividends. Number 3, the dying companies. When you think of the oil and gas, the retail, the cinema, the traditional media, these are companies that are being disrupted by the growing companies. These are companies that we know that over the next 10 to 20 years, they are not going to be in existence. Most of them will be bankrupt because the world has changed from what it used to be. And number 4, the born to fail ones like the Nikola, because the maths and the physics, it doesn't even add up. 7, pick companies that you love. So if you love shopping at Amazon, go for it. If you're an iPhone lover, go for Apple. If you're someone that loves to drink Pepsi, maybe that's something you might have to consider. Pick companies that you love, because when you love a company, you tend to read more about the company. This could be products that you use every day. It could be Facebook. It could be Microsoft. These are companies that if you love them, then these are places that you can put your money to work for you over time. Number 8, stick to large cap and not penny stock. Large cap, these are companies that have market capitalization of $10 billion or more. And how is market capitalization calculated? This is just done by multiplying the number of outstanding shares by the price of the stock. And even if you don't remember that formula, you can just go on Google. You can just put in, for example, Apple market cap. It's going to show you, right? So because large cap companies, they tend to be less volatile, especially when the market is rough, and investors usually over time, they tend to fly towards quality and stable companies so that their investment is secure, right? So don't do penny stocks. I don't do penny stocks because penny stocks, they have no future. I only invest in companies that I believe in, that I know that they are going to be here for such a long time. I don't speculate. I don't hear of this hot stock and I put my money there. Before you buy the stock of any company, it's very, very essential that you do the due diligence. Do your due diligence. Research about the company. Understand how the business, the company operates, right? Because when you're investing in the stock market, obviously you have the expectation to make money and not to lose your capital. So for you to be able to have that confidence, it's essential that you invest in quality, stable companies that you know that when invested in these corporations, the value of your portfolio is going to grow because these companies, they are going to keep expanding, they are going to keep growing, and the more these companies grow, the better and faster the value of our portfolio grows over time. Obviously, you might have heard of a friend or a colleague that lost a fortune in the stock market. As we said in one of our previous classes, that investing in the stock market, it carries some risk. But when approached in a disciplined manner, this is one of the greatest wealth-generating platforms of all time. Just the same way that you would not give a 10-year-old your car to drive, is the same way that you will not just invest in the stock market without doing any proper research. Number 9, investing is simple and not easy. And let me explain. The stock market on average returns about 7 to 8% over a long period of time. The process of buying and selling stock, that is absolutely simple. It doesn't take a rocket scientist to invest. It's pretty easy. If you can operate a smartphone, then I bet you that you're smart enough to invest, right? Investing is very simple because the process of buying and selling stock, you can do it just easy. But where the challenge comes, where the difficulty comes, is the emotional and the psychological impact of investing. In as much as investing is a game of numbers, investing is about the mindset. For example, let's say you bought a stock for $100 and this stock drops to $56. What are you going to do? Are you going to panic and sell? As I said before, if you've invested in solid companies that you know that they are stocks for the future, then obviously you have nothing to panic about, because you know that over time the stock market tends to be bullish. It tends to go upward. So if you're already fundamentally, if you're already invested in companies that are solid, then you have nothing to worry about. For example, if the price of the stock actually dropped 20, 30, 40%, that is actually an excellent time to go and buy more, because it's just as if you went shopping, right? And only for you to discover that everything is on sale, 50% off, 60% off. Nothing fundamentally changed about the company. It could just be what is going on in the economy, but that company is still solid, right? In as much as it's important to talk about the balance sheet, the income statement, the PE ratio, diversification, all of those things, they are very important. But the key to being a successful long-term investor is having the right mindset. It's very, very key, because there are going to be days that the value of your portfolio is going to drop 10%, 20, 30, 40, even 50%. So you have to train your mind to know that if I am invested in solid companies, then I don't need to panic and sell. That is just an investing principle. You don't panic and say, oh yes, the value of my portfolio has gone down. You don't lose money except when you sell. And let me give you an analogy. You went to the amusement park, you went on this roller coaster. They buckled you in, everything is all secured, and the journey starts, right? Obviously, the roller coaster is going to take you to very high heights and to very low valleys. Sometimes the roller coaster could drop you so low that you can literally panic, right? But you know that once you're securely seated, you don't panic and unbuckle yourself when the ride is still on. Because if you do that, obviously, you're going to injure yourself. You're going to be hurt. It's the same thing with the stock market. The stock market is like a roller coaster. It goes up, it goes down. But after a while, this whole madness stops. The same thing, what I'm trying to say, that investing in the stock market, in as much as is a numbers game, it is a mindset. It's a game of the mind, and you have to be prepared for it. And start investing and stay long-term focused. This is very, very important. If you're not investing today, I recommend that you start educating yourself and start right away. You can talk to a financial advisor, you can read extensively online, you can buy books to educate your mind. Because so each day, month or year that you keep pushing off investing is costing you thousands and thousands of dollars over the years. It's just like when you plant an orange seed. You need time for that orange seed to bloom into an orange fruit, and that orange fruit to bloom into an orange tree, and that orange tree to become an orchard. A tree does not become a forest overnight. An orange seed does not become an orchard overnight. It takes time. The same thing with investing. It takes time for you to build and grow your portfolio over time. It takes time. And for you to be able to do that, you have to start early. And I have a bonus one. Invest consistently. Obviously, for you to start investing, it doesn't even take a lot of money. You can start with $50, $100, $1,000. But the key is to invest consistently. It could be every 2 weeks, every month. Just make sure that every time you're putting money away consistently, because the more you add funds to your portfolio and you buy good stock, that means that you are allowing the magic of compound interest to work in your favor. The more good stocks you buy over time, the greater the value of your portfolio grows. And it's very, very essential for you to invest consistently. We've come to the end of today's class. If you found any value whatsoever, please let me know in the comment section below. I read all your comments, I read all your feedback. If you've learned anything from today's class, please give this video a thumbs up, a like, a share, and subscribe. And until next time, I will see you later. Bye-bye. Love you.